with that, let's turn to something that I'm going to say that was a little bit more positive. We did get Q2 GDP in this past week, and we saw some positive news as Q2 GDP did jump to 3% and easily topped the estimate of 2.3%. But it's kind of funny. We're like, well, it's not as bad on the labor market, but with the GDP, while that 3% number sounds good, it's not quite as strong as the headlines indicate. And a big reason for that is, again, I talk about the tariffs, I talk about the messiness that we've seen in the economy the last few months. It really impacted trade imbalances, inventory building. And if we look at Q1 compared to Q2, is kind of the opposite. Q1, we had negative GDP. But because of all the messiness, you dig down deeper, it's like, actually, the report wasn't that bad. Now, Q2, because of all the trade messiness, it's like, wow, things look great. And, I don't want to say they're bad, but they're not as great as the headline showed.
Yeah, so essentially, I mean, it would help to look at both of these two as a whole because, one looked bad because everything was being front-loaded in to try and get ahead of tariffs, and so it looked bad, and now we have these good numbers, but a lot of, the bad part of what should have been in this quarter was just pushed onto the first quarter. So quarter one, the report came back bad, wasn't actually bad because of what happened. This is kind of the opposite, where the numbers look good, but they're not quite as good because of what happened in Q1.
Yeah, I mean, let's talk about those numbers. Q1 companies, they were likely again trying to get ahead of the tariff, so they were really front loading a lot of those imports. That led to a 37.9% increase in imports during Q1, which subtracted 4.66% from the headline GDP number. Well, then in Q2, we saw a complete reversal of that as imports actually fell 30.3% and added 5.18% to the headline GDP number. That's not normal. Trade normally does not move the GDP number by 5.5%. I mean, that is a very strange anomaly, I'm going to say. That is not going to happen, I don't think, for the remainder of the year. I think it is going to subside quite a bit.
Yeah, I mean, we should get more clarity on what's going to be happening with tariffs. We're seeing more trade deals coming on, and a lot of this stuff, April was really crazy as far as tariffs and trade goes. So people were trying to get in front of it. Now we've been in it for a couple of months. Okay, well, maybe it's not going to be as bad as we thought. There's still some uncertainty. There's still some volatility, but, companies and the decision makers are getting a little bit more comfortable with, with the environment that they're in. So shouldn't be as volatile on those GDP numbers and the influence that trade is having on that going forward.
Yeah, and I mean, we talk about trade. Trade also, I think, did bleed into private inventory builds. Obviously, companies were building up inventory and then kind of working through that inventory in Q2. I should say they're building up that inventory in Q1 and worked through it in Q2. This also caused a lot of volatility in the last two periods, considering it did add 2.59% to the headline number in Q1. That is, again, the change in private inventories. But then it subtracted 3.17% from the headline number in Q2, as again, many businesses were likely working through that excess inventory. And this is where it's just so strange, right? I mean, inventories, trade, normally not going to move the needle that much on GDP, especially since we're a consumption-driven economy. Normally, that's what you want to look at with GDP. Normally, that's what's going to move the needle on GDP. But these last two quarters, it's just been so confusing, and you really had to dig into the meat of the details here because there's so much noise with the trade and inventory builds that really distorted, I'd say, the headline numbers.
Yeah, and something else good in the Q2 GDP report had to do with the consumer. So consumer being a main driver for the long term held up pretty well. There was a 1.1% increase in services spending, and goods saw an increase of 2.2%. So increases on both of those numbers, which is good.
Yeah, and I mean, I like to see that. One thing to consider is obviously consumers also knew about tariffs. Was there a little bit of a pull forward in demand on the good spending? Again, a 2.2% increase is nice to see, but we are primarily a service-driven economy. When you think about where people spend a lot of their money, it's going to be on services. So having that 2.2% lift on goods, could that actually subside now in Q3, Q4, and really, again, detract from growth as we move forward? It's something that I am keeping an eye on, because if that does slow and services doesn't pick back up, well, I mean, you could be looking at a GDP growth of maybe 1-2% as we exit the year.
Yeah, so I mean, again, it's all these numbers need to be looked at consecutively. So one number by itself doesn't tell us a lot. So seeing how this evolves going forward will give us a better picture on what everything's going to be looking like.
And one thing as well that got a lot of headlines this last week was obviously the Federal Reserve meeting. And, the big question around all this economic data is, are we going to now see rate cuts? And the market didn't like, the fact, the market knew we weren't going to have a rate cut on Wednesday.
I mean,
That
I
wasn't a
don't
surprise.
think anybody thought that there were going to be rate cuts. But the verbiage or the explanation for it, they didn't really like.
Yeah, and it seems when I first read it, I was like, oh, it seems like Powell's maybe not going to cut in September. But to me, he said, we have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration, all the information we get as we make our decision. So I wouldn't say it was necessarily dovish where he's going to come out and say, yeah, we're cutting rates in September, but I don't think it was as hawkish as a lot of people were worried about, saying that he was absolutely not going to be cutting in September. I think now pairing, again, a GDP report that was okay with a labor report that was questionable, I mean, I think now you could be really looking towards that cut in September because the economy is not advancing aggressively. I'd say, in fact, it's slowing quite drastically.
Yeah, and now with the information that we have with the reports on Friday, I think the case for a September cut is a little bit stronger. After Wednesday, I think people really discounted the chances of seeing a cut in September, but now I think people are looking at that a little bit more. Not only, I mean, previously, market has been doing well, partly because rates were expected, and then when Powell says, well, maybe not, that kind of hurt things a little bit, but now it might be, well, because of those somewhat negative numbers that we see on Friday, cuts might be necessary to keep the economy going.
Yeah, and I would be surprised, again, if data maintains itself around these levels. I would be shocked if they didn't cut in September. I think we'll likely need to see that cut to help with the economy a little bit, but we do have 2 more jobs numbers and I think 2 more inflation prints between now and the September meeting. So there is still more data for the Fed to analyze to really make that final decision. But we did see 2 dissents, which was the first time that's happened, I think, in like 30 years.
Mm-hmm.
There's 2 Fed members that did want to cut. So, I mean, there is that, I don't want to call it infighting, but there is that disagreement. There's that discussion now occurring within the Federal Reserve of, yeah, we should start cutting. So, I mean, I do think we'll see a cut in September. At this point in time, I'm still looking for 2, maybe 3 cuts as we exit 2025. But unfortunately, I don't ask for my votes just yet at the Federal Reserve. But we'll see what happens.